Hey, what's up everybody? I'm John. Today we're just going to be talking about some basic strategy, some risk management, and some basic terminology for those of you that aren't that experienced. I'll just wait for a few people to show up. Hey, what's up, Matt? Alright, so we're going to go ahead and get started here. Just for reference, if you want to follow along, I'm looking at BNGO's chart from yesterday, starting at pre-market up until the spike at 105, and then it started to dip. And we're going to talk about what I was looking at through that trade. But before we get into that, we're going to just do some basic terminology here. I got my binder, guys. I take a lot of notes. I don't take this lightly. I have a good amount of money in here that I would definitely prefer to not lose. So every part of this I take seriously. So I know a lot of you in the group are beginners. So we're gonna just start with the basic terminology that you're gonna be seeing me use on the page. You're gonna be hearing me use in the videos. We're going to start with the most basic. So right now we're in a technical bull market. For the most part, the market is in a recovery from the coronavirus lockdowns, and things are starting to get back to normal. When you hear somebody talk about a bull market, when a bull strikes, they lower their head and they lift their horns to attack. The movement is upwards. The exact opposite is true with the bear market or a bearish movement. When a bear attacks, they stand up, they reach up their claws, and they rake down. So when someone's talking about a bearish market, you can expect things to be going down. Or if someone is a bear in the market, they make money off of the markets moving down. Another one of the real basic things is going to be like blue chip stocks. You know, those are going to be your real safe investments. They're going to be more side to side than up and down, but they're going to be safe. So you've got like Microsoft and Apple and things like that. They're large cap companies that you're not going to see move a lot. The level 2 market data, I can't really stress to you how much that actually helps. The level 2 market data, you can see the bid and ask prices, you can see the spread, you can see orders that are in and have not been filled yet, you can see orders that are already filled. So you can kind of get an idea of what people are wanting to pay versus what people are wanting to sell for, and then you can kind of include that into what you're thinking about doing with your own money. The bid and the ask spread, it's real simple. The bid is what you're willing to pay, the ask is what somebody's willing to sell for, and the spread is that gap. Sometimes you'll hear it referred to as a haircut, and that just means the bid and the ask are really close together. They might be within a penny of each other, and a lot of the times, if that's the case, the stock's going to be moving sideways and not really up or down. Another really important thing is going to be public offerings and initial public offerings. When you see a public offering, that's a company is they're raising capital. Either they're working on something and they need more money to get through the research and development, or they're in debt and they're trying to consolidate. But either way, when a public offering opens, stock value almost always decreases until the offering closes. And when the offering closes, a lot of the times the stock will gap up to the offering price or higher. And that is why people are paying the offering price, because the fair market value is at or above that offering price. So when I'm telling you that there's a low float and the offering's closed, I'm expecting the stock to hit at least that offering price pretty soon. Another really important thing is, how are you reading the charts? The candlestick charts are very important. The line graph, it only shows you the price. It's really not that helpful. You can see the price on the ticker. With the candlestick charts, you can see if the majority of volume for that stock is buying or selling. You can see where the support is at different prices, where resistance is at different prices. And then depending on what charts you're actually using, the ones I use, they include by the minute volume, 2-minute volume, 15-minute volume, 30-minute volume, and RSI for all those time intervals also. Sorry, I just got distracted. My computer screen went off. Due diligence is extremely important. You're not going to get very far in any of this without your own due diligence. I can recommend any stock to you, and it's not a safe move if you don't look into it yourself. And I'll tell you that right now. I can be wrong, you can be wrong. On any trade you make, you have to know that you could be wrong going in. And it's a possibility, and that's why it's important to do your own research. The stocks that I like to watch are highly volatile stocks. I'm not extremely worried about a company going from $1 to, $5 within the next few days. I like to see a large moving average per day. So, like we had a good moving average with BNGO yesterday, or within the last few days. The low that I saw was 0.7043, I believe, and the high was 1.05. That's almost at 30%, above 30% moving average for the day. And even within the last few days, it had been similar, and that's why I was so confident in the ability to make money on that stock. When I did initially buy in too early, and that's okay, that's going to happen. There's good news coming out. I didn't really think I was going to see the low that I had seen before, and then when I did, I bought more. So I got my average down a little bit. It wasn't that big of a deal. But yeah, the daily volatility, that's one of the main things that I'm looking for. The moving average per day or throughout the week. And then I'm looking to buy at the average lows and sell at the average highs. And it does sound like a simple concept, but you never really know. Most of the time, it's always easier if you're expecting the stock to trend up, and that's why I look for stocks with good news expected. And I also look for stocks with a low float. The float shares are the shares that a company has that are still available to be traded, not already being held by somebody or the company. So most of the time, most companies have more than 15 million shares available to be traded at any given time. When you get down into the lower floats, below 5 million, below 2.5 million, the price starts to change more drastically because supply and demand. When there's not a lot of shares available and people want the shares, the price is going to go up. So the asking price is going to go up, and the bid price is going to go up, and the people paying for the stock are going to be getting closer and closer to the asking price, and it's going to continue to push it up as there are less and less shares available to be traded. So that's about it as far as like the basic terminology here. I'm going to get into reading the charts a little bit, and I'm going to flip the screen back around so that you can see the chart for BNGO. Alright, so right here, we're pre-market in the morning. We were already in at this point. I was in the previous day. But we're going to zoom in a little bit here. So right here at this intersection, these are WeBULL charts, by the way, this is free. You can see that there's a good amount of support here at this price at 84, which was good for our initial buy-in. I should back up a little bit so I can show you what I was looking at when I bought. Probably too far. I'm just going to stick here. It's fine. Alright. So, you can see right here, we've got a lot of sell volume and the price is dropping hard, right? And then down here, in the same spot, we have the RSI chart, and as the price falls and the dip hits, the RSI drops all the way to almost 30. It gets to 31, I think was the lowest I saw during that dip. Below 30 is really low. When it starts to get close to that 30 line, that dotted line towards the bottom, every time it gets close, it bounces back because that's a good buy point. Every time it gets close on the RSI to 30, you get a reversal. And the opposite is true too on the upper side up here. Every time you get close to 70, you have a reversal. It only gets close a couple of times, but every time it pushes high on the RSI, it reverses its trend and starts to drop again. And that's how you can see those buy and sell indicators. It's not just about the price movement. The RSI is the relative strength index, and that's basically telling you how confident people are in buying that stock at that price or selling that stock at that price. So that gives you kind of an idea of not just, it gives you a good idea of that price point, of whether or not people are willing to hold or wanting to buy at that price. And then when we get to our spike over here, when we hit 105, we get to our spike over here, the RSI is really high. That's one of the highest points for the day. I'm sorry, I didn't realize I switched the camera back. So when we hit 105, that was the first time, well, the second time that we actually saw the RSI cross the plane at 70, which is that red line right there. So the second time we saw it cross that. And so when I saw it cross it the first time and it dipped, the price dipped a little bit also. I think it hit like 98 or 97. What was that here? Oh, right at $1. Hit 101 and then started to dip again, and the RSI started to go back down. But the news came out, and so there was a lot of confidence. And even though the RSI was still high, people were continuing to buy, and it got over it again. But now that the RSI has hit, that makes it look overvalued. It's over 70. RSI over 70 is high. So at 105, it's starting to look overvalued, and it's those twin peaks, you can almost always expect a decline after that. So when I saw that second peak and I saw the reversal, I've got the peak right there and the reversal from red to green, and then the correction in the price started. Those three things together, and I was instantly out. I didn't wait. I wasn't holding anymore. I was out at 101. I didn't get the absolute max price because I wanted to see if it was going to come back again like it did when it hit $1 and then dropped a little bit and then went to 105. But I didn't wait very long, and that's key. On these penny stocks, timing is everything. And I believe that's about all I had to say about the RSI and the charts. Does everybody know how to read the charts with the resistance and the support? I don't know if you can even really ask questions. First time, sorry guys. That's a good idea, dude. Perhaps for the next time. I wasn't sure how many people were going to be here though, and also with Zoom, I believe the max per group is about 30, right? And we're beyond that. So now we're going to get more into my personal risk management strategies. I do not like to risk a lot of money at one time. I've been doing all right with the market, but I'm not willing or trying to just give it back. Oh, the resistance and support? Okay, I got you. So we're going to go back to the chart for a minute. Okay, so you've got major support and you've got minor support, and you've got major resistance and minor resistance. So the support has a lot to do with the buy and sell volume. And so on the charts here, where, let's see, we'll get to kind of a flatter part in the graph because it'll be easier to see the support where we've got, come on now. So we're just going back to the previous day where it was flat towards the end of the day, and you can see where the support is. So right about here, you've got minor support. So at about 76 cents, that was probably your first level of minor support there. It wasn't a whole lot. The price wasn't moving a lot, but at that price, you had a steady amount of buy volume and not a lot of sell, and then it changed. It was very consistent though. The price wasn't moving. There was good support at this level. Nobody was really trying to get out. Nobody was really trying to get in. And then you've got major support, which happened over here. So over here, we've got at 78 cents. We went from red to green. The buying volume increased. The buying volume increased. So we had major support at this price. It got down here. We had major volume, major buy volume, and then we got to 83, and we met the first level of resistance where it changed from buy volume to sell volume. And then we started to see a decrease in the price because that level of resistance was there. And then it did eventually break through, and when it broke through the following day, the resistance level was higher. And the support was also, oh dang. Sorry. Where am I at? I'm sorry guys, I know the market, I'm not the best with technology. Alright, so then yesterday the support level and the resistance level changed. Here pre-market it got low, but the volume was really low. There are a lot of big spikes and a lot of big dips in pre-market, but the volume is always really low. So even though like the movement is there, you can't always get your orders filled trying to buy and sell that early. But it got that low, and as soon as there became more of a volume of buyers, it started to go up. And then we've got, I would say the new support was right about here at 86 cents. Once we got to before the spike, because we started raising and then it came back down a little bit, and then right around 86 cents here we're starting to get a good support of buying volume, and that's when we also started to lift off. Now that was also the time that the news was released, so the support increased drastically also. Are we good on the support and resistance? So we're going to head more on to the risk management. That's what I was going to head into next. I don't trade a whole lot of capital at one time. Most of my trades are, I have only about $1,000 to $1,500 in the trade when I'm fully into the trade, and I don't ever put it all in at one time. If I have $1,000 set aside for a trade, yeah, I do use SMA a little bit, Mary. I also just kind of read the charts and kind of find what I'm expecting for my own moving average. You can see these candlestick charts really show you a lot when you get used to reading them. You'll be able to see the moving average without really having to look at any kind of indicator for it. You can just look at a long-term chart and see the price change throughout that time frame. But like I was saying, I don't ever really have more than $1,500 in a trade. I keep enough I keep enough equity in my account so that I can actively day trade if I want to. However, I very rarely make day trades. I've tried before. I wasn't the most successful. I do a lot better for myself on these swing trades. And that's a big part of the reason why the other day, when I wasn't 100% sure about getting into that trade, I didn't get in. I apologize though. I should have still got online and told you guys what was happening in case you woke up to saw me. I thought about that after. I'm sorry. So I keep enough equity to be able to day trade, and when I go into any trade, I have a plan already. It's pretty straightforward and consistent through almost all of my trades. When I go into a trade, I'm looking for what I think the new low is going to be. Almost all the trades I'm going into, they're trending up. I'm not that interested in going into things trending down, because while you can still make money in the volatility, it is not quite as easy, and you can hurt yourself if bad news comes out. So I try to get into ones trending up with good volatility. I don't put all my money in at one time. If I've got $1,000 going into that trade, I only put about $400 or $500 in it initially, and then I wait to see what happens, because like I was saying before, you can be wrong on your entry anytime. Jamie, I've been doing this. I've been trading for about 2.5 years. I've been actively trading and only trading for almost 6 months. Dang. I lost where I was at there. Oh, about half of my buying power. No, not really FinViz. I like TradingView a lot more, Chris. I only put about half the buying power into the trade right away. I watch for the new resistance and new support levels, and that way if it does dip more than I expected it to, like, actually I didn't do that great on my entries a few times this week, like BNGO or Gene, I could have done a lot better on my entries. I was expecting a comeback sooner than I did, and so when it dipped, they dipped kind of far, and I just bought more, but that's why I leave capital aside to be able to do that. I still would have made money on BNGO had I bought all in at 8247 was my initial buy. I still would have made 25-ish% because I sold at 101, and that's still not a bad move, but because I saved myself some capital to buy the dip, I ended up making almost 30% on it. And so averaging down can help you. And I like to go about half in on my trade, and then I just watch it for a while, and then I'll put about 20 or 30% of what I have left in there on the next buy-in, and I'll set myself up so I can buy in 3 or 4 times, and that way if I'm wrong and the price goes down, it doesn't have to come back up as much for me to break even or still be profitable. A lot of you have asked me about options already on the page. They are risky. If you're not familiar with options, the contract price has a multiplier of 100. The contract is for 100 shares. The contract price you show is the contract price per share. So when you buy a contract, the price is 100 times what you see, and your risk and loss possibility is also 100 times what you see because you're putting more money in. And if you're wrong on your contract, they can expire worthless. You might pay, I don't know, I saw a really bad one on another Facebook group I'm in. Somebody bought a call option on Tesla that expires a week from today, and he paid almost $2,000 for it, and right now the contract value was like $27. It's I don't know, that's not for me. I'm trying to use this as an income, not as a gamble. So I don't really play options too much, even if I'm really sure. Like, I was pretty sure Tesla was going to dip. It took that dip, and I could have bought contracts and made money on it, but I don't know. I'm not going to bet against Elon, and I'm not a big fan of options in general. I don't know if y'all heard, it was pretty funny. Elon Musk trolled all those short sellers when he sold those red shorts. I'm not going to do that against Elon. And then another big part of the risk management is your due diligence. The more you look into a company and the more comfortable you are with putting your money into it, like, that's managing your risk right there. If you know what's going on within the company, you know what you're working on, what they're working on, and you know what you can expect, your risk is minimized also. And it's not always going to work out. Sometimes, let's see, I was in VRCA a couple weeks ago. They were on the PUDSA phase of testing from the FDA, which is the final level of testing. 80% of companies, or 80% of drugs that get to that phase are approved. And so it's usually a safe bet. 80% is not that bad. I went in on it. I didn't go all in on it or anything crazy because you never really know. And the letter from the FDA came out and their drug was approved, but the application process was not, and the stock tanked because they could not start selling the drug yet. So even though the drug was approved, the application process had to be fixed, and I'm not holding it anymore. I took that loss I got. I literally saw the FDA letter as soon as it was made public, and I sold right away. I lost maybe like 4%. It wasn't too bad. But if you look at the stock today, I was in it at about $8.16, I think, and today it's right around $7. So if I would have held, I'd be down probably almost 15%. And I do think that stock's coming back. It's probably only going to take them a couple weeks to get that application sorted out and approved by the FDA, and VRCA will go from around the $7 it's at now to pushing 15 again as soon as that happens. But there's no telling if this next one is actually going to be the time that it gets approved, and I felt like there was better places to put my money for now. I don't really like to hold that long if I don't absolutely have to. A lot of you all have also asked me about stop losses. Stop losses are very good to use if you cannot watch all the time. I personally am at my laptop watching the market from about, I'm going to say about 5:30 a.m. Eastern Time till after hours close. I'm not just doing this for fun. I'm trying to never have to work again. So I put the time in. Stop losses are helpful though. When I wasn't able to sit and watch all day, I did use stop losses. I would usually set them around 10%, but a lot of the times, I mean, if I had a 10% stop loss on BNGO, it would have triggered and I would have been out. And so with the stop loss, oh man, Nikola, dude, their warrants are available for $11.50 a share and they can instantly be exercised. Nikola's going to be $15 a share in a few weeks. Dang, I got distracted. The stop losses. So if you are going to use a stop loss, don't set it right away. Set it after you're all the way into your buy. So say you buy in and then it dips, and you buy in again and it dips, you buy in again, you don't have any more money, and now your average cost is, say your average cost is, I don't know, $4 a share now. But in the beginning on your initial buy-in, maybe your initial buy-in was at like $4.30. So if you would have set your stop loss initially at 10% and then you bought in and then you bought in and then you bought in, and now your average cost is at $4, and then it goes another, I don't know, what would the math be? Have to go another 13 cents, so it's $3.87, and then your stop loss is triggered. But then you're only losing 13 cents on a $4 a share. That's not 10%. So what I would do with my stop losses and what I do mentally is, once I'm all the way in, my stop loss mentally is about 10% lower than my average cost. And again, it has a lot to do with the charts. If I'm looking at just getting around 10% down from my average cost, but the RSI is really low, I'm not that worried, because the stock is being shown as undervalued and people are going to start buying again and the price is going to come back. And that's why I don't use stop losses, because there's so much more involved than just the market price or the last ticker price. As far as quitting your job, that's really up to you on how much money you need to get by. Before I started doing this, I won't lie to you, I waited tables. There's a bunch of my friends in this group, they know that. When I was doing that, I wasn't making a lot of money, so I didn't have to make a lot of money to cover my bills because my bills reflected what I was already making. And so I really only needed to make $500 or $600 a week, well, after taxes, so really about $850 a week after tax, before taxes, in the market to be able to do this and not have to wait tables anymore. And like, that's not a lot of money, and I do a lot better than that now. But how much you need to be able to make in the market and how much equity you need is 100% dependent on what your own personal bills look like and how much money you currently make and what you need to make to get by. So I can't tell you need $5,000 or $10,000 or $1,000 in order to be able to do this full time for yourself, because your success is going to be the main factor in it. Because if you can find stocks that are going to move 20 or 30% a day, you can make a few $100s a week off $1,000. You can make a few $1,000s a week off $10,000. So it's really just up to you on how you want to do this and how much money you feel like you need to make to continue the path that you're on. I have since been doing significantly better. I've done probably in the last 2 months what I would have made in the last 2 years working waiting tables. And so now and like I said, I move profits regularly. How much percentage you can let it go? So usually around 10% from my average cost is when I let it go. If I'm all the way into a stock and I'm down more than 10%, and I don't like the RSI, and I don't like the trend, and I don't like the sell volume and the buy volume, that's when I'm looking to get out. I try really hard to not ever sell for a loss. I think in the last 2 months I've only traded for a loss one time. Sometimes I have to hold longer than I would prefer, but I would also prefer to not give my money back to the market. So if I have to hold a little bit longer or average down to do that, that's what I do. Dang. And then I'm trying to see, I got some notes here. So you're going to hear me talk about low float shares a lot. That's the main thing that I look for, is low shares on float. That's directly related to supply and demand. It's the less shares available and there's demand for it, the price is going up fast. What you can say about oh man, I appreciate the comment, dude, but I'm not going into analysis on individual stocks during this video. We're just going over basic things. So on individual trade capital, what I have personally, almost all of my net worth is in equity, but that doesn't mean that it's in stocks. I've got a lot of it in mutual funds. I've got now that I've built some up, I've got a lot of it in mutual funds because, I mean, it's kind of safe. We all saw what happened with the market crash, but I bought them after that, so I got them for cheap. And then you can also just leave liquid in your portfolio. Just because it's in your portfolio doesn't mean you have to buy anything with it. You can leave cash there. Warren Buffett was holding liquid for a really long time, and people were starting to think he was going crazy and making fun of him. And then the market crashed, and then he bought everything super cheap, and he made a ton of money, and it's because he held liquid and was worried about what was coming, and he was right. And so holding liquid can benefit you greatly sometimes too. It doesn't have to be in shares. But when I do get into an individual trade, I usually trade less than $5,000 a week. I'm usually in multiple positions. It's very rare that I'm 100% confident and I'm putting more than $5,000 into the market at a time, or into volatile stocks at a time. I have more than that in the market because blue chips and things like that, but I don't really consider that the same thing. That's really just keeping my money safe, and I have the equity in there so that if I want out of a trade, I can get out of it anytime because I can actively day trade. But that's more risk management also. Like, my reason for having that equity is not so that I can day trade every day. I don't day trade every day. I don't know. I like having the option to be able to get out of a trade at any time if something happens, if bad news comes out and it's not what I was expecting and it sounds like something that's going to make it go down. That 3 intraday trades every 5-day sliding trading day window is rough sometimes. You get stuck in a bad buy and you can lose a lot because you can't get out. And that happened to me once or twice before I had the equity, and it will never happen to me again. Another one of the things I look for is small cap companies. Small cap companies, they don't have the type of money that, I don't know, a company like Amazon or somebody like that has. Amazon's a huge example because they probably have the highest market cap that I can think of. But the small cap companies, I get in on those a lot because it takes less money to move the market on those. When things like BNGO came out, I don't know if any of you actually did any due diligence on that. They used the Sapphire as a technology that they created, and it decoded the genome of the COVID strains and made it way easier for them to trace where it's coming from and track like its path and who's passing it to who. And they are the only company out there that has that technology, and that technology will work for more than just COVID. It's going to work on a ton of viruses, bacteria, pretty much anything that holds DNA because it decoded a genome. So they're working on that. And so your due diligence is important. And so that small cap company, a lot of money came in. I forget what the market cap was when I bought in on Wednesday initially, but I remember seeing it yesterday and thinking it was almost $20 million higher than it was on Wednesday, and that was a big move for a small cap company. And that's reflected in the share price. The market cap is basically all the shares available times its price, and that basically gives you the market cap. It also includes debt and equity, but we don't really have to get into all that because that's kind of getting a little bit deeper. Maybe we'll save that for next weekend. Steve, you asked about margins. I don't trade margins account. I have before, and my account is set to a margins account, so I can trade margins trading if I want to. I don't do it very often because that's the only way that you can lose more than you put in, and I just don't like that possibility. I also don't like the idea of short selling in general. I don't think that companies should give that type of leverage over the company. I don't agree with loans being on share or shares being on loan. And so I don't really trade the margins, but that's more of like a personal preference. I don't want to borrow shares from somebody, sell them, expect them to go down, buy them back and return them. I know you can make money that way, and I know a lot of people do, but I'm not a bear trader, I'm a bull trader. I would prefer these companies be successful that I'm investing in rather than trying to tear them down as they're doing poorly. It's kind of an ethical thing a little bit, but the market's also cutthroat, so do what you gotta do to make money. I mean, I'm not gonna down you for it, that's just not my move. That really is all about I had planned to cover today. I do appreciate everybody coming to watch. Did anybody have any more questions before I get off? No? Alright. I appreciate you all coming. Yep, I agree, Steve. I agree. Tomorrow night I'll be posting my picks for the week. Likely to be the same as what I posted Friday afternoon. And if any new news or research turns up in my due diligence, I will pass the info along. I appreciate y'all coming. ABIO is going to gap up big.